Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenivek on Bloomberg Radio.
Our focus shifts now to the latest development when it comes to Russia's invasion of Ukraine. The two countries wrapped up a second round of talks, these happening in Istanbul, but they failed to bring the two sides closer to ending the war. They laid the groundwork for a new exchange of prisoners, however. The Russian delegation handed over peace proposals that include Kyiv surrendering control of territory it still holds in 4 partially occupied regions. This according to a Ukrainian official. We did also hear from the Ukrainian defense minister who said that Kyiv demanded an unconditional truce. For more, we bring in Dr. Angela Stent. She's senior fellow at the Brookings Institution. She's also former national intelligence officer for Russia and Eurasia at the National Intelligence Council. She also served in the Office of Policy and Planning at the U.S. Department of State. And she's author of the book that came out in 2019. It's called Putin's World, Russia Against the West and with the Rest. She joins us from Washington, D.C. Dr. Stent, good to see you. It's been about a month since we last connected. I do want to start with peace negotiations, but before that, kind of get to the context of what happened over the weekend, the drone attacks, so-called Operations Spiderweb. Russia and Ukraine are each saying different things about what exactly happened, the damage, what was destroyed. Zelensky did say that about a third of the strategic cruise missile carriers at airfields were hit. How does this complicate negotiations?
Well, I think you may remember that President Trump told President Zelensky at that unfortunate meeting in the Oval Office that Ukraine, quote unquote, had no cards. I think this was really an amazing operation. It had been planned for 1.5 years, we heard from the President Zelensky, and it shows that Ukraine does have some cards. It was capable of destroying these Russian strategic bombers that were being used to hail bombs on civilian and targets and infrastructure in Ukraine. And these, by the way, are old Soviet-era planes, and they can't be replaced. So it'll take Russia some time to rebuild, to acquire some more of these strategic bombers. It doesn't necessarily change the course of the whole war, but it certainly shows that Ukraine can fight back, that it's very good at this kind of advanced warfare, using the drones in trucks, if you like, the Trojan trucks, as they've been called, and really apparently taking the Russians and everyone else by surprise. But as you said, at today's talks, yes, they agreed to exchange more prisoners, which is very important. But there's been absolutely no more progress made on approaching a ceasefire, any kind of an end to the fighting than there was, when President Trump first took office.
I want to get to that ceasefire, but just briefly, I'm wondering if there's geopolitical implications of this attack beyond just how it affects Russia's war with Ukraine, but how this could potentially affect Russia's relationships with other countries.
Well, it has major implications for warfare in general. Some people are now saying that what Ukraine really did was to help NATO, because it makes it less likely, at least, that in the immediate future, Russia would be able to attack a NATO member. But it has implications even for the United States. I mean, if you can now destroy planes and other military hardware through the use of drones like that, people are going to have to rethink where they position things and how they conduct warfare. So it potentially has major implications really for the way that countries fight wars in the 21st century.
But this was a difficult thing for Ukraine to pull off. I mean, some of the reporting around it indicates that this was over a year in planning processes. They were able to get drones into the country and then have them take off simultaneously to attack different strategic assets of the country. This is not an easy thing to do, Dr. Stent.
No. I mean, it took a lot of meticulous planning. Obviously, the Ukrainians had people inside Russia who help with this. President Zelensky last night in his address said that some of these people were located very close to a major headquarters for the Russian domestic intelligence services. But it just shows you that this is a war that's partly resembles World War I and trench warfare, but is also a very high-tech 21st century cutting-edge type of warfare, of which we will see more in the future.
So where does this leave us now? Because the two nations spoke today, but it doesn't seem like they're any closer to making progress towards a ceasefire.
No, they are not. I mean, Vladimir Putin is not interested in a ceasefire at the moment. Russia has been taking incrementally more territory in the past few months. It's also sustained very high numbers of casualties as it takes this territory. But he is, I think, determined to continue with this war. Most people believe it's going to go on at least for this year, if not into next year. But the negotiations will continue because Putin has understood that if Russia doesn't take part in negotiations, then the prospects for improving U.S.-Russian relations, which President Trump had promised him, go down significantly. So I think we'll see. I know they've already said they're going to have another negotiation not in the not too distant future. They may continue to talk about these humanitarian issues. Again, very important issues, the exchange of prisoners, particularly disabled ones. But that doesn't mean that the fighting is going to stop anytime soon.
Dr. Stent, we're getting a question from some folks who are watching or listening right now. Want your view on over 3 years in, on year 4 of this war, when many thought it would last a couple of weeks, what you view as the original cause of this war?
The original cause of this war is that Vladimir Putin has never accepted the collapse of the Soviet Union. He has never accepted that Ukrainians are a separate people, that they should have a separate country. He believes that they should be part of Russia. He wrote that explicitly in a July 2021 5,000-word essay that he penned about Ukraine. So the root cause of the war is that Russia believes, under Putin, believes that it should control Ukraine, and that Ukraine shouldn't have any choice in moving westward, in joining Western institutions. So that's the original cause of the war. A lot of the discussion we hear about NATO enlargement causing it, that's not the cause of the war. I mean, the reason that Putin didn't like NATO, didn't want NATO to enlarge is because if Ukraine had been a member of NATO and Russia had attacked Ukraine, then it would have been involved potentially in a large scale, possibly nuclear war with NATO. So NATO is not the root cause of the war. It's Putin's desire and the desire of many people around him to reconquer Ukraine.
Dr. Stent, we started the interview by you saying that this drone strike over the weekend was proof that Ukraine does indeed have the cards. Do they have the cards to force Russia to negotiate in a way that does not include actually giving up part of Ukraine's own territory?
So I would say they do not have those cards. I think what they have the cards is to make Russia understand that it's going to be more difficult as the fight goes on. But I think the only way to get the Russians to negotiate more seriously would be two things. One, there is a fairly robust sanctions bill that 81 senators, bipartisan in the Senate, support, and that Senators Graham and Blumenthal, who were just in Kyiv, said that they would possibly pass this week. It hasn't happened yet. We'll see. But those would be very punishing sanctions on Russia, and it would be for the Trump administration to resume supplying Ukraine with the weapons and the financial assistance it needs to continue fighting Russia in such a way that Putin might have to understand that his maximum demands cannot be met and that he would be willing to make some compromises in the demands that the Russians are making.
Just 30 seconds, but what's your current thinking on how the war ends?
Eventually, it will end in a negotiation, and it will be a negotiation clearly where both sides will have to compromise, and both sides will have to move back from their maximum demands. But I think neither side is at the situation yet where they're willing to make those compromises.
Dr. Stent, always appreciate you taking the time and joining us here on a Bloomberg Businessweek Daily. Dr. Angela Stent, Senior Fellow at the Brookings Institution, also the author of the 2019 book, Putin's World, Russia Against the West, and with the rest.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
President Donald Trump and Chinese President Xi Jinping are likely to speak this week, the White House said, as the world's two largest economies remain locked in trade turmoil. For more, we bring in Jennifer Welch, Bloomberg Economics Chief Geoeconomics Analyst. She joins us from Washington. Jennifer, I just want to start with the lay of the land right now, because we're a little over a month away from the end of this 90-day pause that the president had laid out for every country that it's negotiating with around the world. What is the average tariff rate that we should keep in mind for goods that are coming from China into the U.S. right now?
Well, at the moment, the U.S. effective tariff rate on China is closer to 40%, with the 90-day pause on the higher reciprocal tariffs that came into play after April 2nd, after the tit for tat between Washington and Beijing. But as the call's lead up has indicated, the wheels are starting to fall off of that truce. And we might see tensions come to a boil well before that 90-day period is set to end. And I think the threat there is whether or not tariff rates are going to go back up again. Once that 90-day truce ends, will there be an extension of it to allow for a larger deal on trade? At the moment, the signs are pointing pretty negative.
You know, I was sitting in the studio with Tom Keene doing Bloomberg surveillance a couple weeks ago. And in one single day, we spoke to two analysts. And this was before the 90-day truce. We spoke to two analysts who told us that within weeks, we were going to see empty shelves here in the U.S. It doesn't seem like that has materialized. Yes, there's been a pause at this point. Are you, based on the research that you see, the folks that you talk to, are you seeing that's still a concern, given that so much of what we buy in the U.S. comes from China?
I think the 90-day pause allowed for companies that had already been surging orders in advance of Liberation Day, anticipating that tariffs were going to go up, allows them to continue to make orders and through at least this 90-day period. So it has bought some space and it has bought some time. They are facing higher prices, but they are not facing the kinds of exorbitant prices at the 145% tariff rate that we were in mid to late April that would have made many of those orders cost prohibitive. So I think it has bought some space, and that's why we haven't seen empty shelves. We may still see price hikes, though, because that 38% effective tariff, that's a high rate, higher certainly than where we were before April 2nd. But I think it has avoided some of the shortages that we were concerned about before this truce was reached in Geneva.
I'm wondering if, in your observations, these, maybe some cracks in the trade truce beginning to show, how much of that is just a normal part of a negotiation between two of the world's largest economies?
I think given the experience of the first U.S.-China trade war, at this point in time, I would say history suggests that this isn't surprising. In that trade war, we saw multiple, what I would call potential off-ramps, where both parties had the opportunity to take a step down from trade tensions that were either bypassed or only lasted a temporary period of time. And we also saw multiple rounds of escalation and tit for tat, even when it seemed likely that the two parties are maybe reaching an agreement of sorts. Ultimately, it took 2 years from the initiation of tariffs to the conclusion of a deal in the form of the phase one deal and that trade war for tariffs to come down. And even then, the phase one deal didn't last very long before tension started to spike again. I think that helps explain the backdrop for today's trade talks, where there's deep levels of distrust on both sides. Both sides, as you're implying, are still looking to gain leverage, even though they've agreed to this truce. And that's probably part of the reason Beijing has been slow to peel back these export controls on rare earths and other critical minerals that the U.S. has complained about. That's leverage that Beijing wants to continue to retain, in addition to the administrative challenges of peeling back export controls. And on the U.S. side, there are a number of steps that the United States wants to take as part of its competition with China outside the trade domain. And from Washington's perspective, a trade truce doesn't mean that it agreed to pause all of that. But from Beijing's perspective, I'm not going to agree to something in the trade arena when you're hitting me on export controls or on student visas at the same time.
Mm-hmm. White House press secretary Caroline Leavitt told reporters today that, I'm just going to quote it, "I can confirm that the two leaders will likely talk this week," of course, referring to Trump and Chinese President Xi Jinping. This would be the first time since they spoke, correct? Since Trump took office. What would this mean?
It would be the first time that we know if they've spoken since he took office. President Trump has indicated that they spoke at some other point in time, but he hasn't provided specifics of it, and there was never a readout from it. So we don't really know if that call ever happened. I think it's highly unlikely that Beijing in this atmosphere would agree to a leader level call. From Beijing's perspective, that's just incredibly risky. They don't want to put President Xi Jinping in a position where he could be embarrassed or surprised in the way that some other foreign leaders in meeting or talking with Trump have been. Their preferred MO is for the leaders to meet and to talk once they have something to announce, which usually requires more progress at working levels. Obviously, that flies in the face of President Trump's preferred approach, where he likes to work things out with his counterparts. And that often is a faster path to resolving differences. And so if a phone call happens this week, I think that is a good thing for trade negotiations. It probably will help restart momentum, or at least clear the air in a way in which these tensions aren't kind of boiling on the back burner. But I think a call is unlikely. And what that means is that tensions could continue to boil because they're only being addressed really at lower levels. And it would take a higher level engagement to put them to rest, or at least to put them into the background to the point where they're not interfering with talks further. So my anticipation is, despite what the White House press secretary said, I'd be very surprised if a phone call did happen. And I'd be, as a result, very surprised if we had a quick resolution to this current period of tension versus a decision to kind of continue to let things boil and work them out at the lower levels.
Hey, Jennifer, we're going to try to fix your mic a little bit. But Emily, one thing that I wanted to talk about with Jennifer, we've got a couple minutes left, hoping we can fix the connection, is who has leverage in this negotiation? I mean, China has the rare earth capacity for refining these rare earth elements. We've talked about that with Jodo quite a bit, and Gracelyn Baskren over at the Center for Strategic and International Studies. They also have the stuff that we want to buy as consumers, but we have the consumers, Jennifer. I want to go back to you and bring you back in here. Who has the leverage when it comes to this negotiation?
So in a sense, both sides have leverage. Obviously, from the U.S. perspective, they are China's single largest market in the world. And there are very limited options for Beijing to shift those goods to other locations. At the same time, manufacturing is increasingly a very important part of the Chinese economy. It has been for decades, but especially in light of their property bubble and some of the other challenges that they have had with consumer sentiment. At this moment in time, with their other economic weaknesses, manufacturing becomes an even more important part of China's growth hopes. On the other hand, for the U.S., the weakness is really in terms of consumer dependence on Chinese goods, that there aren't a lot of alternative options, or it's certainly not within U.S. consumers' price preferences. And so both sides are going to face incredible pain here if tariffs resume higher levels. For China, it will be in the form of dropped exports. As a result, the impact it's likely to have on factories and in course of that, an impact on jobs. On the U.S. side, it's going to be in terms of much higher prices for U.S. consumers, to the point where some goods might not be available and there aren't ready alternatives for those goods. So both sides certainly have an incentive to avoid a return to higher tensions here. But at the same time, the depth and deep persistence of these trade tensions against the backdrop of distress makes avoiding that outcome a real challenge.
Jennifer Welch, Bloomberg Economics Chief Geoeconomics Analyst, joining us this afternoon from Washington.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Look at that. We're just about 19 minutes from the close of equity trading, as we just heard from Jordan Fitzgerald. About 0.3%, but a strong day for tech right now. The NASDAQ higher by 0.6%. The Dow is flat. Let's bring in Alan Zafran. He's co-founder and managing partner at IEQ Capital. About $36.8 billion in assets under management. He joins us once again from Foster City, California. Good to have you back on the program. We haven't spoken since, just after the tariff pause. So mid-April just after the tariff pause, I should say, Alan. It's been quite a while since we've last spoken with you. Good to have you with us this afternoon. That's exactly where I want to start, because we're going to get to the Fed in a minute. We're going to get to sort of asset allocation and how maybe it's different than a few months ago. But with regard to U.S. trade negotiations, in your view, how do things stand right now?
Well, first of all, Tim and Emily, thanks for having me on the show. Look, it's unclear, right? On the one hand, our administration is talking to China and arguing that they're going to delay the imposition of some of these tariffs. But then the next thing you hear is there's, again, conversations about maybe it's not going to be so easy. So the last we heard is President Trump will talk with the head of China later this week. And the intention is to get the conversations back on track. If you have the two largest economies in the globe not acting well with one another, clearly that's a negative globally. And so I think on a short-term basis, where this market is headed, stock market, is measuring the ability of our administration to get its way to some degree with some imposition of tariffs while not being too problematic or hurtful to other countries' administrations, so that we can work out face-saving agreements on both sides of the oceans or both sides of the country. So that's the game. Are we going to find some middle ground that enables the U.S. to argue it's won in the imposition of some tariffs for the benefit of protecting our domestic industries, but at the same token, in a way such that other countries' administrations can have face-saving agreements on behalf of their own citizens? That's the game to play right now in terms of tariffs.
I saw a note this morning. I'm blanking on who wrote it, but the analyst was mentioning how it seems like markets aren't reacting as strongly on Monday mornings when we get like news over the weekend about U.S.-China relations, which we did get this weekend. It's not like we saw a massive drop coming in Monday morning. What do you make of that? Are investors getting tired of all of the headlines about tariffs and the trade war, or are there actually real developments here that kind of signal meaningful progress that could be good for the equity market?
I think it's a little of both. First of all, I actually think there's a tremendous amount of cash still on the sidelines, which goes all the way back to the stimulus that was created as an effort to fight COVID.
Wait, you still think there's still cash on the sidelines?
Yeah, I do.
Wow.
I think there's a lot.
Who's got it?
There's like a record in money market funds, right?
I know it's in money market funds, but I'm thinking of more of like who still has, $1,000 or whatever we got from PPP or from those emergency COVID funds.
Well, that's a whole another conversation we could get into, but I think the most affluent portions of the U.S. Citizenry have significant wealth, which has only grown since COVID, and they have ample amounts of cash to put to work on dips. That's why I think you keep seeing the buy the dip mentality. On top of that, to answer your question, Emily, on top of that, I think what you're seeing is people are coming to a conclusion that the current U.S. administration only has a tolerance for so much pain in the markets before it's going to revert back to a more amenable set of tariffs that the global economies can tolerate. In a world in which we have 10% on average tariffs imposed by the U.S., not ideal, but it's a global economy that can still grow, if even at a slightly lower rate than it would have otherwise. And that's dramatically different than a world with 30% tariffs, which puts probably us into a global recession. So I think investors have concluded the administration is teasing out the middle ground and therefore is not reacting to the day-to-day headlines as to 50% tariffs on steel or whatever product or service of the week that they're going to talk about. I think the investors are more discerning and realizing it's probably not going to be as bad as it was feared when we had our dramatic drop in early April.
Alan, when do we start to see those actual tariffs make their way into actual prices that we're paying for stuff?
You're actually starting to see it a bit because producers and service providers are already anticipating some of that, but we haven't seen the bulk of that yet. And in fact,
is that just because we're making our way through inventory? Like, we heard from the retailers earlier this week, or last month, I should say. in this most recent earnings round that they're still working through inventory that they had pre-tariffs. Is that why?
That's a large part of it.
Okay.
The other issue concern, though, is imagine a world in which everyone's holding off on offering their products out of a concern if and when and how the tariffs show up. So there's also a bit of front running, right, where products are going out the door as quickly as possible in avoidance of the tariff being imposed on them. So when you may see some dramatic step shifts up in prices if, in fact, tariffs become legislated into law. So it depends on the product and service from the country.
What do you think is most at risk?
Well, I think most at risk are really where we're trying to protect create a fair playing field. So it's anything from importation of energy services to, oddly enough, things at risk like the notion that maybe foreigners are going to get taxed on investments in the U.S. That's an easy one to impose on foreigners. It doesn't hurt us. So you're going to see the reverse. And then we don't know how to predict if other countries will impose those costs back on U.S. investors to non-U.S. investments. That might be a next step we haven't seen yet.
Hey, I want to shift gears a little bit before we go. Just get your word on what you're seeing with alternatives right now, private credit and private equity, venture capital. Certainly is a relatively large portion of the way you invest the money that you manage. What's the opportunity there right now, and how has it changed in the recent months?
As it relates to private credit, we have not seen a lot. So interestingly enough, despite concerns about economic slowdowns, let alone recession fears, we're seeing little, if any, evidence that there's any degradation or decline in the ability of private companies to pay their debts, meaning private credit, in our mind, still is a highly attractive asset class, yielding much higher annual income streams than what you can buy from the public bond markets. In the private arena, secondary investments, when you're the buyer of someone else's illiquid investment, we think you're going to see more and more of it for two reasons. Most recently, there's news that a lot of the universities are finding themselves having too much illiquidity, finding a need to raise cash for potential increase in tax rates on the returns on their investments. And so they're coming to the markets with portfolios of investments that secondary buyers, the second investors, can buy at a discount.
Okay.
And we're seeing a lot more of that. We're probably going to see
Alan Zafran, IEQ Capital. Thanks for joining us.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Shares of Starz soared 27% on a Friday. This after the company said it added 530,000 streaming subscribers in the U.S. during the fiscal fourth quarter. The company is now a standalone entity. It separated from Lionsgate Studios. It began trading independently last month. It's got a market cap now just north of $300 million. Today, it gives back some of those gains from Friday. Shares falling as much as 14%, down 9.4% as we speak. We're joined here in the Bloomberg Businessweek studio by Jeffrey Hirsch. He's president and CEO of Starz. Jeffrey, good to see you. Welcome. Investors welcomed the streaming additions in the fourth quarter. You increased total subscribers in the U.S. by close to 2%. You attributed that to the premiere of the fourth season of Raising Kanan. What's in the product pipeline right now, the content pipeline, that will continue with the growth?
Well, thanks for having me. It's good to be here this afternoon. We have a great slate in 25. We're coming off a strike-affected year where we only had 3 big tentpole shows. And so that created a little kind of gaps in our content. And so what you see as we roll into 25 is we've got 5 big shows coming. We have BMF, which premieres this weekend, which is a 50 Cent show, one of our biggest shows. So we're excited about that premiere this weekend. We roll that into Outlander prequel called Blood of My Blood, which I think the fans will really like.
This is why Carol's going to be so mad she's not here today. She's like the biggest Outlander fan around. Yeah, that's okay. We'll tell her. We'll tell her.
The prequel's, it's 20 years prior to the first season of Outlander. It's back in Scotland. It's Clan Lauren. It's 2 romance stories. So it's how each of the leads of Outlander's parents met and fell in love. So one of the stories is a Romeo and Juliet story, rival clans, forbidden love. The other is World War I, with a gentleman on the front and a woman reading the letters. And it's a phenomenal tale. There aren't any books. And so the fan base, it's all new to them. And so I think it's going to be a really great show. We come back with a fan favorite from 12 years ago called Spartacus, which is going to be, I was talking to the producer on the way down here. He's like, is it coming back? I'm like, this fall. And so that's going to be, and Stephen DeKnight's doing that. It's going to be as good as, if not better than the original. We come back with Force, which is one of our Power spinoffs, and then back into Kanan. So real strong year of content. We wrap that with, big movies from Lionsgate like Ballerina, and then Universal has a couple movies coming, Oppenheimer. So it's really great portfolio of content coming this year. We're pretty excited.
Talk about your target demographic here, because it's not every single person that wants to watch TV, right?
Yeah, we're really trying to be complementary to all the broad-based streamers. In 2016, when we launched our app, what we saw from the data, and it was the first time we really got data on our subscribers, it was that women was driving our business. And so we leaned in significantly into that. And so our content is really only focused on women and underrepresented audiences, and not only on screen, but in the director's chair, in the writer's room, all the way through the office. 70% of my direct reports are women and 80% are women of color. And so it's really a network for buying about women and underrepresented audiences, run by women and underrepresented audiences.
Do you see yourself trying to broaden out the content to bring in more people or make it a bigger tent? Or is this the niche you want to focus on? And look, I'm not saying it's a niche. It's a huge target market. But like Emily said, the other streamers want to have everything.
Yeah, look, they want to be all things to everybody, and they're competing with themselves. And we really are focused on, like I said, women and underrepresented audience. We think that TAM in the U.S. is about 80 million households. Okay. We're sitting at 20 million households today. So we think there's a lot of room to go. And if women in is a niche, which are 49.6% of the planet small, then I'm happy to have everybody else focus everywhere else and let us do what we're doing. So we'll continue to be complementary. We'll continue to really be the destination of R-rated adult scripted content for women. And so we feel good about that.
So you don't have ads right now on the streaming platform. How do you grow revenue then if you don't have ads?
So I think there's really three ways we can grow revenue, and we'll grow revenue 1% to 3% in the next short-term period. One is subscriber growth. Like I said, we've got a lot of TAM still out there today. You saw that in the first quarter, we grew the base 1.8% in the U.S., and so we think there's a lot of opportunity. And as these broad-based streamers continue to compete, it'll look a lot like the old world where you have Starz sold as an add-on or buy this service and get Starz included. So we think there's a real opportunity for us to kind of replicate that unique position we had in the traditional world in the new digital world that we are today.
So you're saying look out for bundles?
Look out for bundles.
Do you have any now?
We are the most bundled service in the space today. We have 5 bundles. We are about to launch another one this week. In the first quarter, we had a BET Starz bundle on Amazon. We had an HBO Max Starz bundle on Amazon. We've actually bundled BritBox into the Starz app. It was the first one we bundled into ourselves. So we are set up to bundle with almost everyone.
What's a bundle you're working on?
Can't tell you that today, but
but describe it for us. Like in an ideal world, these we went through a few years about a decade ago where the major telecom companies were bundling this stuff. If you subscribe to AT&T or Verizon, you'd get X or Y for free. That was unique in the context of, okay, you're paying for a cell phone plan, you're getting content for free. What world do you want to see?
I think the nice thing about bundles, I think everybody looks at it and says, well, for the consumer, they get a discount and the companies get stickier. What really makes the bundle unique and special for the companies is you're lining up your content slates together. So, for example, last quarter with HBO Max, The White Lotus launched in February. They didn't have a big show launch in March, but we had Raising Kanan launch in March. So when you put those together, you have 2 big premieres working with each other to continue to drive subscriber acquisition. So when we look at the landscape that's out there today, we look at content that's either complementary or folks that are servicing the other side of the household that we're not. And if you can put our service with their service and complete the loop for the household, it's a really compelling bundle for consumers.
Tim mentioned this is you're relatively new as a public company. It's been not even a month, right, from separating from Lionsgate Studios. Talk a little bit more about just how that split is going to help Starz now.
I think the board 3 years ago looked at the combined company and said investors like a simplicity in story, and the fact that you had a studio and a network together wasn't that simple, and it was hard to figure out where to put your investment dollars. I think investors like to invest in content or distribution and not kind of a hybrid. And if they are going to put it in a hybrid, we were such a small cap company at the point you put money into Comcast or NBC Universal or Disney as a hybrid there. And so rightly so made the decision to split the 2 companies to put value back on each of the companies. I think you've seen that in the stock performance on both Lion and Starz over the last couple of weeks. But ultimately allows us to focus on what we do best, which is really put great content on the air, own our own content, and drive our subscriber base to ultimately drive profit and return money. We got a 15% margin today. When we get into a steady state in 26, we'll convert 70% of that to unlevered free cash flow. So profitable business, generating a lot of cash for investors, and we think it's a very investable business.
Go ahead, Emily.
I'm curious, when you say own your own content, what does it actually mean in practice? That it's only on your platform and you would never sell it to others? Do you own the production supply chain as well? How does that work?
So today, everything that we have on Starz is exclusive to Starz for a period of time. It's a window that when you license Outlander from Sony, you get an exclusive window where they can't sell it to somebody else domestically against you, because we're only US and Canada. But you're licensed, you're renting that content for a period of time. When you have ownership economics, not only can you control costs better because you're actually in there daily making it, controlling the cost, but you create other revenue streams. So for today, if Outlander gets to be sold internationally, that money goes to Sony. If I own the show, I can actually put revenue streams on international sales and second window domestically, where I can net the cost down. So it allows us, as we turn the slate over and get to half the slate in 27 being Starz owned, we can start to drive margin for the business, which ultimately should be multiple expansion.
You're coming to this business, or you're at the helm of this as an independent business at a time when cord cutting is just absolutely rampant right now. I mean, when just a few years ago, for you, it was a 100% pay TV supported business. That's what Starz was. Now 70% of the revenue comes from streaming. You're still exposed to cord cutting headwinds for about 30% of the company. How do you combat that? How do you make up for the cord cutting revenue that you will inevitably lose with streaming?
So two things. One, I still think there's a lot of opportunity for us on the linear side, because remember, we're not a fully distributed ad-supported network. And so there's still opportunity for us to try to grow the business. And as you see with DirecTV, with skinnier bundles and Charter now leaning back into video, I still think there's an opportunity for us to play in the bundle world on the linear side to drive growth for the business there. 80% of all of our customers, whether they're on digital linear or a la carte or rev share, which means two things. One, we're making money for our partners. But two, people chose Starz because they wanted the content. And so the content has to work. And so at the end of the day, as long as the content continues to outperform and be some of the biggest shows on television, we'll grow the business on both sides.
Emily mentioned that you don't have advertising. There were years when I was covering Netflix when they were saying, we're never going to do advertising. We're never going to do advertising. And look what they're doing now. They're doing advertising. Are you ever going to do advertising?
I don't think we're going to ever do advertising with the Starz content. It's, we don't have a lot of content. We have about 10 originals, so-called 100 hours of content. It's called 600 minutes of advertising. It's very R-rated. It's very adult. So it cuts a lot of the advertisers that won't advertise on our service. But I do think, we built our own app. We have our own data stack that's very scalable. And that gives us the opportunity to actually help other linear networks that are marooned on the linear side that don't have a digital future, and actually do some commercial deals where we could actually take the linear feed, turn it into digital, launch it next to the Starz app, and have an advertising supported business next to our subscription business and take some of the economics on behalf of our partners.
So essentially what you're saying is you could have maybe a less expensive consumer version that is ad supported in certain areas.
Correct.
When would that be?
Right now like we said, we're 3 or 4 weeks. It's about separation right now. We're really focused on making sure we're setting up the business, talking to investors, making sure everybody understands the growth story. And I think eventually the 2.0 will come pretty soon.
Cool.
Do you feel in this environment that you have pricing power? Because this is a space where consumers, there's so many options for what you get for your streaming. I know some people, it's like, I already have Max, I already have Netflix, and I have Hulu. There's just a lot of choice. And a lot of times people judge on price.
Yeah. So, as a complimentary service, we've always wanted to be priced significantly below the broad-based streamers. So, Netflix without ads is $24. I think Hulu's around 18 or 19. We're at 11. So as long as they keep continuing to raise that price, it gives us the ability to raise underneath it, because in the consumer's mind, anything that is, that much, has that much gap, people see it as a complementary decision versus a competitive decision. So we always want to be significantly below the broad-based streamer. So I do think we'll have some pricing power. We've done 2 rate increases over the last 2 years. I think that's something we'll take a pause on for a while and get back to just pure subscriber growth for the way to grow. But we reserve the right to do some increases in the future.
Emily raises the question about pricing power when it comes to consumers. What about the pricing power that you have to compete with the huge companies such as Amazon, Netflix, Max, and the likes? When you're out there bidding up content, how do you compete?
So it's interesting. I think we have a specific mission. We really focus on women and underrepresented audiences, and we were just out in a very competitive bid for a book called All Fours, which has really taken America by storm and the 40-something women in America. And when we went out and met with Miranda July, who's the author, because we are so R-rated, we are adult, we allow the author and the writers to go where they naturally, authentically would go versus pulling stuff back. For her, the only destination to really put her book, to bring it to life on TV as authentically as she wanted to be, was Starz. And so we were able to win that competitive bid because of the mission that we have. And I think you see that not only in content, but when we hire folks, people come to Starz because they understand that we have a point of view and we have a mission and they want to be a part of that. And so it's been very helpful having a specific lane and really kind of leaning into that in a way that is very deep and authentic.
Jeffrey Hirsch, thanks for joining us.
Thanks for having me.
Yeah, good to see you.
Good to see everybody.
President and CEO of Starz joining us here in the Bloomberg Businessweek studio.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.